In the late 1990s, the world stood on the edge of a financial precipice. The internet wasn't just a technology, it was a savior, a new god of limitless possibility. It promised unimaginable wealth, and investors, entranced by its brilliance, weren't just blinded, they were possessed. It was a delirium of greed. Startups with no profits, sometimes not even a functioning product, were handed fortunes fit for kings. Their stock prices didn't rise. They detonated, fueled by the pure, explosive oxygen of hype. Then came the alliance, reckless, euphoric, unstoppable. Wall Street hurled mountains of cash at anything ending in .com. Companies still in infancy were dragged to IPOs with no questions asked. Rationality was murdered, replaced with a primal terror of missing the one, miraculous ticket to billionaire heaven. The market wasn't just a casino anymore. It was a fever dream with infinite chips. These empires were built not on profit, but on illusion. They burned cash at a terrifying pace, chasing users they could never afford. Their value drifted so far from reality that even gravity seemed optional. It was the triumph of fantasy over logic, a collective hallucination that the internet had rewritten the laws of economics. Speculation spiraled out of control. Stocks like Qualcomm and JDS Uniphase doubled, even tripled, within a few months. Analysts dismissed traditional metrics, claiming a new paradigm existed. This massive speculative bubble peaked in March 2000, with the Nasdaq Composite at over 5,000 points. The air was thick with expectation. The illusion of endless capital could not hide a lack of sales forever. As months passed, reality crept in. Companies weren't hitting their promised sales targets. They were burning through their venture capital, a problem known as cash burn. The first major cracks appeared when the Federal Reserve began to raise interest rates to slow the overall economy. This made future earnings, which were always uncertain, look even less valuable today. The tipping point came on March 10, 2000. Investors, realizing their positions were unsustainable, rushed to liquidate. What followed was a self-fulfilling panic. Stock prices fell at breathtaking speed. The Nasdaq lost 10% of its value in a single day. Fortunes evaporated overnight, resulting in the start of one of the largest market corrections in history. The fallout was brutal. Thousands of dot-coms, having never achieved profitability, folded entirely. High-profile companies like the online grocer Webvan and the much-hyped Pets.com vanished, taking their massive valuations with them. Over the next 2 years, the Nasdaq would lose over 78% of its value. Billions of dollars were gone, exposing the fundamental flaw in the get big fast strategy. The dot-com crash was a devastating market correction, but it was not the end of the internet. It was a painful stress test. The companies that survived, like Amazon and Cisco, were forced to adopt sound business practices and focus on actual profit. The crash taught us that hype cannot replace financial fundamentals. Technology was the future, but even the future needs solid ground and a clear path to profitability. Understanding this bubble is essential to recognizing and avoiding the next one.